This is Colin Cattell with Palisade Capital, and we have the opportunity to sit down with Don Coxe today, Chairman of Coxe Advisors. Don, thanks so much for sitting down with us.
Pleasure.
Okay, I want to jump right in and talk to you about the yellow metal. Things have been heating up a bit over the past few weeks, and gold has made a steady climb up. Don, is the bottom in for gold?
Thanks. Well, I have already said publicly that I believe we did see the bottom around 1200, and that doesn't mean we're going to have a gold rally, but we have now some of the things in place that are required. In particular, we have the largest short position on gold speculator longs in history, and we have the shortest exposure, negative exposure from the industry, which is miners and refiners and jewelers. And by definition, they have to always be short because they're taking the price differential between the metal that they're buying and what they can sell their product for. And so that means that those who know it best are now convinced that they can produce profitably what they make at these prices. And those who know the least about it have this gigantic short position because they just see it's been going down. So with that kind of backdrop, what we're going to have is any rallies will require a lot of these shorts to cover. That's clear markets. In addition, the money printing in the world is so far beyond any experience since paper money was first invented by the Chinese. And therefore what we know is that the fundamental relationship between gold and paper money will eventually reassert itself in gold's favor. People forget that in the gold boom that occurred after Richard Nixon closed the gold window in 1971, taking it from $35 up through to $350, the rally that took it up to $800 was against a backdrop of sharply rising interest rates because people had lost faith in paper of any kind, whether it was cash or bonds. And so they rushed into gold. And then when Margaret Thatcher, followed by Ronald Reagan, embarked on serious fighting of inflation, they destroyed the basic argument for gold, and we had a 22-year bear market. We now have a situation where the paper money that's being printed is so vast, and as soon as we have any attempt to fight inflation by raising interest rates, we're going to have a collapse in the bond market. And that takes away the secure investment that people have had, which was investing in bonds. We've had a 30-year bull market in bonds, the longest on record. All bull markets eventually end. So you take that away, and what that's going to be is devastating for the stock market because the correlation between the S&P 500 and Treasury bonds has been tremendous. And so much of financial engineering is going, when you get to the stage that IBM floats a bond issue at 1% in order to pay dividends, and when the biggest bond issue success of this year was Apple bonds, there was just a buying panic to buy them. Apple didn't use 1 cent of that to invest in their business. They've used it purely to buy back stock and to pay dividends. So what we have then is the formation of the top of the bond market. And we've already had the first lift off the bottom. Lots more is to come. So people will always try to find some investment which is immune to further rises in interest rates. And eventually they will come to believe in gold.
Bond yields have also been on an upward trend, and you've stated that the 30-year bull market in bonds has come to an end. How will gold outperform in an environment with rising bond yields?
Well, it must be that people lose faith in secure investments that they understand that have a current rate of return delivering money and say, no, I've got to protect myself against longer-term disaster. And the gold rally, when it comes, is for those who have something they need to protect, wealth they have. The key to gold is not so much that people buy it to get rich, people buy it because they have to have something which will hold its value. And that time will come, where it's those who have something to protect as opposed to those who want to speculate on getting rich. And there's enough people in the world who have financial resources to protect, and when they see that nothing else is working, they're going to want to add to their positions in gold. Already we see the cash market for gold much stronger than the futures market. And particularly in China, as more and more people get rich, the Chinese are buying gold like mad. They're the biggest buyers now. They've taken over from India. So we're seeing this thing which is, I've got to protect what I have. And that is a more visceral reaction than fear is always more important than greed. And so the buyers of gold who are buying to protect what they have are far more important than those who are buying because they think they got a trade coming.
What do you make of Ben Bernankes' talk of tapering? There was a bit of a worldwide sell-off in markets around the world when he made the suggestion that he'd be cutting back on QE. Why'd he come out and suggest tapering?
Because he's an honest man. He's a great central banker. He saved the world with what he did with printing money. But he's thoroughly aware. He spoke at Milton Friedman's 90th birthday party, and he said, "We have learned your lesson, Milton." And we learned that the Fed policy in 1930 was disastrous. So he respects Milton Friedman's views on the relationship between the quantitative supply of money and inflation. So he is worried that this continuous process, and now when people talk of it going as zero interest rates are going to last till 2019, that would be destructive of the pension funds would be bust all over the place because they must use the rate on good corporate bonds as a minimum for using their projection of the future costs of the pension fund. And if people are projecting that you're not going to get more than 4 or 5% on bonds forever, then since the pension funds need at least 7% on their portfolio, then that's what Ben Bernanke understands. He was asked at a conference at Princeton, well, what you're doing, Dr. Bernanke, has worked for saving the economy, but it's at the expense of the seniors who save through insured bank deposits and pension funds. He said the Fed has two mandates, to control inflation and to provide strength for the economy. And he said nothing in our mandate is designed to protect those groups.
And earlier you mentioned demand for precious metals coming out of China. What about the industrial metals and other resources? What is your outlook there?
Well, it's not as clear-cut, but I have now been through 3 cycles already since I proclaimed the commodity bull market, where they said it's the top for commodity prices. And the industrial metals, because they're a clear supply-demand situation, what we have to see is that there's enough economic growth in the industrial world to offset the fact that China is going to go to a controlled growth policy. And fortunately, we've got a new player, the 3rd biggest economy in the world, which is now growing rapidly. It's the fastest growing economy in the industrial world, which is Japan. And I'm a believer that this time Japan will remain the strongest industrial power for at least the next 3 years. That automatically creates demand for base metals.
Great. Thanks so much, Don.
Thank you.